So, with your trading, have you ever struggled to preserve your capital and actually stay in the game? Well, if this is you, then welcome to today's market brief. As always, my name is Francois. I'm your market analyst here at ATFX Africa. And today we are going to be diving into one of the most important points within trading, which is risk management. Now, many traders often obsess about their entries and their exits and their trading strategies and how they analyze charts. But the truth is, risk management is what keeps you in the game. I've always said this multiple times. Without capital, you are physically incapable of trading, unless you're trading a demo account. So today, to help me unpack this very, very crucial topic, I am joined by Nomhle. So Nomhle, welcome to the Market Brief. Welcome to today's show. Could you please tell our viewers a bit more about yourself and how long you've been in the financial industry? And yeah, then we'll get started from there.
Well, thanks for having me, Francois. Just to give you a bit of background on my experience in the industry, I have about 12 to going on 13 years in the financial market space. I started off obviously with equities such as how do you buy a share on the JSE and so on. And right now I've moved up, I'd like to think, move up to your CFD trading. So that's pretty much in a nutshell my background.
Absolutely fantastic. So 13 years in the industry, so we definitely have a lot to talk about today. I think let's kick things off with many traders focus, as I stated when we started, on strategies, entries, exits, but risk management is that silent driver of long-term success.
Yeah.
So how do you explain the difference between surviving in the market? Because I think that's what so many of our traders are doing nowadays. They are purely surviving instead of thriving. So how do we differentiate? How do we find that difference between surviving in the market and thriving in the market from your perspective?
All right. So firstly, just to explain how a client who's surviving in the market would look like, it's usually the client who says, I hope that that this trade goes in my favor. It's the hope strategy, right? Hoping that the position that you've just taken, it doesn't blow. Hoping that you don't lose all your capital on one trade. Hopefully that you'll see another day to trade again. I think it comes with surviving the markets. It's like your basics as well would apply to it, such as you're not trading with money you cannot afford, as well as setting your stop losses and you take profits and so forth, only because you don't want to wipe out your accounts, right? But when you're looking at thriving in the markets, it's completely different. It's looking at the latter. It's someone who has, I don't want to say perfected, because it isn't such a thing as being perfect in trading, but someone who's comfortable and has grown confidently in their strategy to a point where they can end up compounding their returns. I'd say that's the difference between surviving the markets, which is hoping, and essentially thriving in the markets, which is being able to make more returns from whatever winnings that you might have possibly made.
Absolutely fantastic. Nomhle, you just mentioned something very specific. You spoke about stop losses. And the majority of the time when we speak to traders, this is kind of all they think risk management is. Okay?
Yeah.
Am I using a stop loss? Yes or no? If I'm not using a stop loss, I'm not applying risk management. If I'm using a stop loss, I'm applying risk management. But you and I both know this is not true.
Yeah.
So what are some of the overlooked dimensions of risk management, such as maybe to explore correlated assets or liquidity risk or anything in that regard that traders don't necessarily pay so much attention to?
I mean, I like that you just mentioned the correlated assets, right? Because if, for example, a client is trading the euro dollar and then they're trading the GBP USD, essentially they double it's like doubling the exposure on the dollar, because whether you like it or not, your money is still trading the dollar, either on the Euro USD or the GBP USD, right? So that's the risk that the clients they would not look into. I don't know whether it's an education factor or it's something that just misses, goes over their head. Or sometimes it's just a simple thing as closing your trades on a Friday so that you're not exposed to the market during the weekend for a potential or possible market gap when it opens on a Monday. You leave on a Friday, you're on $1,000, you come back, you're on a minus $5,000. And it's possible, right? Because of such small things that you might not have looked into. Volatility as well. It's something that the clients don't necessarily look at. They think, and again, I don't necessarily blame them, because this is the information that has been put out there, is that a stop loss alone is more than enough. But it's not, because like I said, in the event where there is a market gap and the stop loss that you've set doesn't even exist, you can't necessarily be taken out of a price that doesn't exist. But having to actually manually close your position yourself also forms as part of risk management, to say that, you know what, I've had enough, I'm happy with the returns that I've gotten, and getting out of the trade.
Super tight spreads? Yeah, tighter than your jeans after Christmas lunch. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
Awesome. And it's so true. I mean, we've seen so much volatility lately within the market, especially on a Monday morning when the markets reopen. Even this week itself, there were so many gaps within the market when the market reopened. And I mean, it opened on a public holiday and it was still gapping. So very, very true. But let's move a little bit forward now and add to the entire risk management conversation regarding position sizing. Okay, so professional traders often size their position based on volatility rather than account balance. I know I do this personally, where based on normal market open, my position sizing looks a lot different than what it looks like when I'm trading NFP.
Yeah.
So, and again, a lot of traders most of the time takes, I almost want to say, a one size fits all approach. So do you think retail traders should adapt that volatility based approach to their risk? And how can you help them to practically implement this?
Well, I can't advise, but but obviously it makes a lot of sense for them to adapt that, because you're essentially scanning to see how aggressive the markets are, right? When you're looking at the market volatility or how wild they are. And based on the wilderness, you want to be able to control the positions that you're taking. Essentially, that's what it is. And institutional and professional traders have mastered this to say that, you know what, a 2% in a volatile market compared to a 2% in a non-volatile market, it's not necessarily the same, because there are tools in place that you can use, obviously, to make sure that you are positioning your trades based on how wild the markets or how volatile the markets are. You don't always have to sort of like try to figure it yourself, because the tools that have already been built, like your indicators, your average true range that they can use as an indicator to pretty much sort of like distinguish where exactly, whether they should scale down on the position or whether they should scale up on the position based on the volatility. And it has had, and I've seen the impact it has as well with more strategic traders, and that use that concept for trading as well.
Fantastic. A little bit earlier, we spoke about, if traders apply risk management, they have this mindset regarding either I'm going to, blow my account, so we have that risk of ruin, or I'm going to actually make money. And I think a lot of traders actually underestimate the impact of risk of ruin. And when I'm talking about risk of ruin, is then when you actually blow your account and you have to fund it again and you have to start again. And I mean, you've dealt with so many traders who have consistently gone through this process where they fund their trading account, they don't apply proper risk management, they blow the account, they have to start again. And instead of taking a bit more of, again, the risk-based approach where we can grow that. So how can traders calculate, if I want to put it in this way, a more personal risk-based approach that can prevent or help them steer clear of actually blowing up their accounts?
Okay. So with risk to ruin, obviously you're looking at how many times must I burn before I learn the lesson, right?
For me, by the way, it was 6 times.
That's essentially what you're asking. How many times do you want to be in pain before you learn the lesson, right? And that's a question a trader should ask themselves. How many times am I willing to suffer on blowing the accounts before I can learn the lesson? But going back to how they would calculate it, it's a simple concept. Honestly, let's say you had $1,000, and if you were to place 1% of $1,000, it's different to placing 10% exposure on $1,000, or even let's actually put it all the way down to $100, right? If you were to get into a position with just $1, you've got 99 more chances, probably, right? If you should just get in with $1, you have 99 more chances. But if you're getting in with $10, you only have 9 more chances. So the risk to ruin comes back to the client is, are you willing to just blow your account within 2 attempts, or do you want to stretch it a bit so that there is leeway to recover?
Zero commission on stocks? Yeah, nothing. What if you could get this value today? Turns out you can. Join ATFX now and let's get you started.
I like what you're saying, but I kind of want to guide my next question in a different aspect, because the fact that I love the numbers-based approach that you just took with regards to, if I have $1,000, this is how much I can risk. If I have $100, this is how much I can risk. But we all have this mindset coming to trading that, I'm here to make money, okay? And making $1 a day, well, are you really making money? Yes, you are making money, but it's not really helping, or most traders don't think it helps, but they don't always understand that even if you're just starting with $100 and you're growing that by $1 a day, eventually it becomes $2 a day, $3 a day, $5 a day. As you go down, you said you've been doing this for 13 years. So it's not a slow approach.
Yeah.
So how much of the struggles that traders are facing nowadays, especially when it comes to risk management, is not so much a numbers problem, but a psychology problem?
60% of the traders, I'd say, actually even more. They struggle with the psychology part.
And how do we fix this?
How do we fix it? It's education. It's people like yourself, Francois, where, for example, you take the time and dedicate yourself in educating clients on what psychology in trading is. You take your time in educating clients on risk management. Now, it's the client's responsibility, fortunately for you, to go and actually learn, right? It's to engage and have open discussions, but not only open discussions, but to actually implement it and test it out on their own. Have a trading journal, record everything that you're doing so that you can see, is what you're testing out actually playing out factually, or is it just in theory? So I would really challenge clients to test it out on their own accounts, and obviously with a lot of education backed up, and obviously I would say hopefully leveraging your expertise as well, they could go really far.
Fantastic. Let's wrap things up for today, because I think you've already shared so much with us today. But in the last 13 years, you've seen markets evolve. You've seen markets change. The way traders look at the market today is different from how we looked at the market in 2019. And that consistent change also brings in risk, which we need to manage. That's the entire purpose of risk management. So, in your view, which risk factors do you believe is becoming more apparent in today's market that maybe wasn't there 5 years ago, that traders need to make themselves aware of and adapt so that they can, well, thrive and stop surviving?
So I'm glad you asked that question, because we're constantly having a debate around this. And I'd say one of the factors would be geopolitical events. We have had a roller coaster ride when it comes to geopolitical events. No one expected COVID, but it happened. No one expected the price of oil to go all the way down to $10, but it happened. We have robots these days that are creating fake outs that clients are not aware of. There's a lot of factors, like I said, that play part into managing your risk. And if you're not informed of some of these factors, you'll only rely on your stop loss. But if you're educating yourself to know what are the other factors, like having such conversations with you, it's where you better equip yourself to know, okay, cool, this weekend I'm expecting the NFP results, right? Or I'm expecting the Fed rates, which is something that's going to move the market by, this is the expected results, right? Back in the day, you wouldn't really find clients monitoring the economic calendar as religiously as clients these days do, because it was just about spotting out an opportunity every now and then you take your wins or you take your losses, and that is it. But this day, it's more strategic. It's about building into the bigger trading plan and having those smaller sort of like plans in place, where if you know that I've got X amount of target over the long run, which is, let's say, over a month, but I know that over a daily sort of like trading strategy, this is what I need to implement in order for me to hit my monthly target. But with obviously with the news events that are coming out as well, and how the markets have been changing and becoming even more and more volatile, and more assets being introduced as well, I think this only gives opportunity to clients to learn more on how to better manage their risk. And the nice thing now is that you don't have to trade one asset. It's not just trading Eurodollar anymore or just gold, right? There's different assets that you can trade if you don't prefer such volatility.
Absolutely fantastic. Nomhle, thank you so much for sharing such amazing insights with us here today. And to those of you watching here today, I do hope that you have gained a better understanding regarding risk management and how risk management really is the backbone of being consistently profitable and being consistent in your trading success. So if you haven't done so yet, please remember to like and subscribe to our YouTube channel. And with that, we come to the end of today's market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's market. Simply head over to ATFX Africa by clicking on the link in the description below and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.